What is the future of alternate funds in India? I mean, whether it's private equity, whether it's private credit, and you as a house, you have all of these strategies. So is there, more legs and arms to that growth? Or do you think SIF is going to be the so-called Judwa Behen of mutual funds?
So I feel that time will say how SIFs evolve, but for now I believe AIFs are, I think they've evolved, they are maturing, and a lot of interest. So if you look at overall, the industry has grown, I mean, since 2012 when the licenses were issued, so about 12 years it's a 10 lakh crore industry, right?
Hello everyone, welcome to Kotak Konversations. This is a podcast initiative by Kotak Mahindra Bank where we meet industry veterans and delve deep into markets, magic, mania and a whole host of industry related stuff. In today's podcast, I have two industry veterans. They do not need any introduction, but yes, I have to do the honors. And we have Aashish Sommaiyaa, CEO of White Oak Asset Management. And we have Akhil Chaturvedi, who is CBO at Motilal. Welcome to the two of you.
Thank you.
And I have known them for now over 2 decades. Exceptionally passionate about what they do, and that is exactly the reason why they are here as part of the podcast. So we have 3 enthusiasts, that's including myself, who are going to try to make the next few minutes as interesting and as meaningful as possible for all of you. Aashish, I want to start right up with you. The industry in the mutual funds, and you've lived through the entire 2.5 decades plus, is now at what, almost 70 trillion rupees or 70 lakh crores. We've seen proliferation of monies coming across the length and the breadth, financialization of things. We know all of that. But my question to you is specifically pointed on the fact of passives. In this era of 70 trillion rupees, where we're seeing so much of money flow, what do you think, are we as a nation trying to toe the line very similar to what's happened outside of India, in the rest of the globe, with respect to proliferation of passive funds and specifically factor-based investing?
So, I think passives are here to stay, but there are reasons for the development. Like say, for example, if you build a case for passives around the fact that it is, say, simplicity. Right? I mean, a lot of times I tell people, if you don't know what to buy, you buy the market, correct? And in our country, fund houses like Motilal Oswal, for example, if you can, for 500 rupees, if you can buy Nifty 500 and S&P 500, that's that. I mean, what else do you need to start your investing journey, right? So if you build a case around simplicity, yes, there is, a lot of case that can be made for passives. But what happens is that when you talk about passives, a lot of times I've seen a case being made for the fact that you can't generate alpha, or a case being made that because there is no alpha in the US, even India will follow that line and we will not be able to generate alpha. Now that's where I actually beg to differ. The reason being that the journey and the market construct in US is very different. I'll give you a simple example. In last 30 years in the US, market cap has gone from 13 trillion to north of 60-65 trillion. But in that time frame, the number of listed companies in US has become half. And in US, there is enough data to prove that the alpha has gone into the private market, and it has been disrupted from the public market. Now, India's market construct is nowhere comparable to that. In our country, Sev, Bhujia and potato manufacturer are also getting listed now, correct? So the market is yet to be discovered. So I would say that, if you, like I said, if you say fintechs, if you say advisory practice, if you say basic principles of asset allocation, simplicity, all of that demands building blocks where passives have a role to play. But when it comes to alpha and when it comes to scope for active management, I think still we have some journey to go.
So Akhil, taking cue from what Aashish just mentioned, there is a case for active and passive. So, let me dig into the alpha part, which is largely through mid-market companies or small cap companies. We are again seeing a lot of money coming into mutual funds, predominantly into these two segments. In your opinion, with handling HNIs and large family offices, do you think mutual fund is the best way to participate into these mid-cap opportunities, or do you think think there is another like a direct equity route, and you think that is much better? Any views on that?
Yeah, so I think if you have to really participate into mid cap and small caps, mutual funds actually offer you a whole bouquet of opportunities. Whether it's on the active side, whether it's on the passive side, I think there's a lot of innovation which is going on to capture this particular space. But more specifically in the HNI, UHNI space, I think incrementally what we are seeing is a lot of demand for the unlisted space, or the pre-IPO crossover funds, right? So there are a lot of opportunities where newer emerging businesses are coming into the listed space. So these opportunities for people to participate either directly or through the fund route. So if you see the private equity side, or if you see some of the crossover funds, or even buying some of these stocks in the unlisted space, I think that space is growing really very, very fast, right? So essentially pre-IPO, most of the businesses will be small caps and mid caps, and then they tend to become large caps once they're listed, or upper end of mid caps. So I think the scope is widening. I think there is a strong case for both PMSs, mutual funds, and AIF to really take use of this opportunity.
But tell me, Ashish, again, I'll stay with this point only, but, on the fact that we are seeing influx of data, and I'm sure you're doing more of slice and dice of this data. One trend that we are seeing is that the tier 2 locations, are witnessing, I would say, the mecca of this kind of flows that are coming in with maybe more information access or technology access. Are you also witnessing similar kind of trends? Is it to do with the demographics? Is it just that everybody wants to make money, and you're seeing a lot of entrepreneurship kind of led wealth creation also happening in tier 2 cities, right?
So I think, say, take an example. We are relatively a young fund house, less than 2 years. Our first fund came 2 years back. So you can say we've been around 2 years or less. Even for a fund house like us, 25 to 30% of the SIPs that we register is not top 20, 50, etc. 25 to 30% of the SIPs registered are outside the top 100 locations itself, right? So it's much beyond this tier 2, tier 3 kind of scenario. And I think the largest credit for that actually goes to two things. One is our regulator, obviously, because you've been part of the industry. There's no industry in the world which spends 2 basis points of the entire assets to explain to people about mutual funds sahi hai. Right? It's unparalleled. There's no such country in the world which has that kind of industry. So I think that has helped. And second is, I think, with digitization and with the access to, digital platforms and apps and websites, I think information arbitrage completely killed. Let's say you talk to a mutual fund distributor 200 kilometers outside Banaras, or you talk to a mutual fund distributor here in Mumbai or in some suburbs. I think the best of distributors everywhere have the same knowledge and the same information, and there's no information arbitrage. And the knowledge access is pretty much there to everybody. When we are talking, it's not going to be restricted to Bombay or Delhi, right? Everybody in the country will watch. So I think both of these things have really helped. The industry's efforts to take mutual funds ahead, and digitization and digital transactions and digital access to information and knowledge. I think that has really flattened out the whole system.
No, true. And I think the industry has done an exemplary job of ensuring that this mutual fund sahi hai doesn't remain just a slogan. It actually impacts your portfolios. But Akhil, let me transport you to an offshore destination of your choice. I know dollar rupee is depreciating, but this is with respect to investments. If somebody wants to gain diversification outside of India, I know we know actives, passive, large cap, mid markets, all of that is fine. But today LRS is obviously one very potent route where he or she can wire money. But the aspirational India is only growing, and therefore the wealth creation is very high. And mutual funds now have a cap, right? They always had a cap. The cap got enhanced, and now there is an absolute no-go. What are the other avenues? If somebody wants to diversify outside of India, how does he or she participate? And if you were the FinMin, would you make any changes to it?
No, certainly. I think we are as a AMC playing a large role in actually, we were the early ones to actually launch some of these opportunities for Indians to invest outside of India with our Nasdaq and S&P 500 fund. Industry has reached the limit, fund houses have reached the limit, and believe me, given where we are today, especially in India, there is a lot of demand for, especially US, right? Now, unfortunately, we cannot take money. In fact, most of the AMCs have had to stop the SIP flows also. Now, the other way, so mutual funds is a very convenient way. The other way is only you're left with the LRS, right? Now, when you look at LRS, opportunities are very, very limited. Very few fund houses have set up in GIFT City and trying to manage whether active portfolios or passive portfolios, but those opportunities are very limited. And then there is a ceiling of $250,000 per PAN. So eventually, for a retail investor, it's fine, but for HNIs, if you are a family of four, $1 million may be a very, very small allocation. So it's a challenge, and if I have to make a recommendation, I think we need to expand this limit within India itself. So maybe it's a doubling of the limit, or maybe it's tripling. Given that we have over $600 billion of reserve, I think giving $20-30 billion for Indians to invest through mutual funds will be a very, very good option for people to diversify their portfolios into other asset classes outside of India. So I would make that recommendation. But for now, yes, we are limited to this $250,000 kind of limit.
Yeah, I would, dread to think what happened if you were told that you cannot travel beyond 2 times a year outside India, or 3 times a year. I don't know what that number is. I think very similar thing is happening to investments. And I think when it's investments, it has to flow freely, right? If you are allowing the influx of monies and there is no cap on that, ideally, it takes time to obviously change mindset. But yeah, hopefully somebody is listening to this podcast as well.
Other than investments, if you look at, even if you want to travel abroad, I mean, a family of 4, if they go for a vacation, there is a TCS. You're going abroad for studies, there is a TCS. So that becomes the second limitation in general if you want to do anything which is outside of India.
No, absolutely. I think we will tell Kotak Mahindra Bank to do a separate podcast on that for sure, because it's an eyesore, right? It is hurting a lot of people. I know that लोग बोलते आपका ही पैसा आपको वापस मिल रहा है, but मेरा पैसा जाए क्यों पहले? That's the key thing. But Aashish, we discussed about the mutual fund industry, and I've been with the industry for now over 2 decades plus, and I've switched gears to the alternate industry now, which is equally exciting. Now there is a category called SIF, which is the new kid on the block, and obviously mutual funds definitely have an opportunity to launch that. How do you see that? Is it too early days? Is it like khoda pahad nikli chuya types, or do you think that this is going to be the next Pushpa of the financial services?
Yeah, no, I think it's, I don't know, won't bat for the extremes, but I think it's more likely to be the latter.
Okay.
I think it will take away some business from AIFs as well as from PMS. The reason is because, when you look at this SIF, the specialized investment funds, there's, mutual funds clearly over the last 25-30 years, they become mass retail vehicles. But then, with mutual funds also, investors become more experienced. The level of information and knowledge and the wealth, the risk return expectation, everything kind of grows over a period of time. So, the regulator probably wants that even if investors want higher risk order, then maybe they should take it through regulated entities like asset managers. And that's why what they're doing is, in this specialized investment fund, a lot of the things which are not allowed to mutual funds, a lot of guardrails which are put in mutual fund management, those guardrails have been kind of relaxed. So single issuer limits, how much you can hold in a stock, whether you can have lock-in, whether you can have an interval fund, whether you can have exit loads. I think a lot of those things have been relaxed, correct? Now, as a result of that, what will happen? Let's say in PMSs, if you're used to running very concentrated portfolios, what a specialized investment fund will be allowed to run a concentrated investment portfolio. For example, if you see credit funds, the learning is that you should not have an open-ended credit fund. You should restrict liquidity. Mutual funds are not allowed lockups. So this SIF is going to be allowed a lockup. So typically, if a lot of credit funds were being done in AIFs, you might have a retailish credit fund done on a SIF. Then combinations of derivatives and equities, correct? So my sense is that certain categories from PMS and AIF will move into a specialized investment fund. And at the same time, let's not forget that even in mutual funds, sometimes some high risk products are done. I'm sure the regulator will redirect them to an SIF. Say, for example, if somebody does a very narrowly focused sectoral fund, say transportation and logistics, doesn't have a big universe, right? May not be relevant for each and every retail investor. the regulator may well redirect it, saying that, why are you filing it in a mutual fund? You should be filing this in an SIF. So I think it's going to work both ways. And in my sense, it will become a big part of the industry in the next, say, half a decade or so.
Excellent. So we don't know if it's going to be the Pushpa, but it is certainly not going to be a flat tire, is the view.
Yeah, it will be significant proportion. I don't know whether to call it 10%, 15% or what, but it will be a big proportion of the industry.
No, so then should I move back from AIFs to mutual funds? I don't know. That's a question which I need to answer.
One clarification, I don't know if he knows, but I think the tax benefit which is applicable to mutual funds, I think that will be one big motivation for investors to flock into SIF.
No, very true. But Akhil, my question to you, therefore, is the follow-up, is that we know mutual funds, we know SIFs, and now alternates anyways are, growing. Log bolenge base chota hai. There's always a cynic and an optimist in a room. But what is the future of alternate funds in India? I mean, whether it's private equity, whether it's private credit, and you as a house, you have all of these strategies. So is there, more legs and arms to that growth? Or do you think SIF is going to be the so-called Judwa Behen of mutual funds and try to take share, as Aashish rightly alluded to? Is that going to happen?
No, I feel that time will say how SIFs evolve, but for now, I believe AIFs are, I think they've evolved, they are maturing, and a lot of interest. So if you look at overall, the industry has grown, I mean, since 2012 when the licenses were issued, so about 12 years, it's a 10 lakh crore industry, right? And large part of this AUM is actually in the private equity, real estate and the private credit space, which is the CAT 2, which itself is about 8 lakh crores. So which means that there is a lot of interest amongst UHNIs, family offices in this space. So if the products are good, innovation is there, I think investors are eventually agnostic to which vehicle they are coming. They are looking at more what kind of opportunity which is available, and irrespective of the pros and the cons, we feel that this will continue to grow.
So there's not going to be an Amavasya moment for AIFs?
I don't think so for now, but yeah, SIFs, like one thing, I mean, what kind of products, what kind of opportunities, we are still waiting for a lot of clarity. But like I said, this tax structure, which is akin to mutual funds, how this will pan out, it will depend. But for the unlisted space, real estate, venture capital, angel investing, long short strategies, I think for this, AIF regulations are far more flexible as compared to SIFs and mutual funds. So I think there's a big runway for AIFs.
Aashish, we've gone through this entire Samudra Manthan as far as the asset management industry is concerned. Bring in the distribution angle here. There are a lot of these online platforms which are doing, not doing, and they're all bits and pieces. How is it going to change the landscape of two sets of category? One is the traditional distribution, brick and mortar, jisko hum bolte retail mein, and probably advisory. Any thoughts, any views, how you guys are seeing this, or anything that the regulator is seeing differently?
See, till now, I think what was happening was that a lot of the fintechs, they feigned to be, or they came under the garb of advisory. And, they were just offering direct plans and using it more as a mode of acquiring customers, right? So, you offer direct, acquire customers. And because there was no execution only format, they were portraying that they are advisor, but obviously not advising, just providing access. So now clearly you have a segregation that most fintechs are now execution only. So they are not distributors, they are not advisors, you call it a listing or a yellow pages for mutual funds. Then there are registered investment advisors, and then there are distributors clearly, right? Now advisory practice, so execution only I clarified, it's more the fintechs which are listed yellow pages for mutual funds. Then you have the RIAs. RIAs, clearly, I think there are execution challenges because there are people with the right mindset, people with the right attitude, maybe the right competency, in my humble opinion, because you're making it everything incumbent upon the RIA to fulfill and take all the boxes. But for example, a simple thing like how do you ensure that a customer pays the fee? After having taken advice, how are you protecting the interest of the advisor also? So I think there are some challenges in implementing the RIA, and you can see that many people are not able to take it up. In fact, some have given up their licenses. So I think somebody needs to review all of that. And then there is the distribution. I think distribution is something which is most practical. A lot of times when people talk about RIA practice, they say it's ideal RIA is ideal because it avoids any supposed conflict of interest because you're paid by your customer, not paid by the issuer or the manufacturer. So yes, conceptually true. But mutual fund distribution actually may not be ideal, but it's the most practical and the most workable solution. The other thing is that for retail, you cannot have RIA. I mean, let's say we are sitting in BKC. If somebody calls me from Borivali and says, I want to do a 2,000 rupee SIP, can you come and help me? Right? That's going to be 24,000 rupees for the year, and it's going to be 120,000 for 6 years, right? And the mutual fund distributor won't even earn $1,000 for that. So no wonder nobody's going to go to Borivali to collect a 2,000 rupee SIP. And everybody is not equipped to do all of this, on a self-aided mode. And for 1,20,000 invested over 5 years, how much can you pay the RIA also? Yeah. Correct. So I think for large part of retail, distribution is the way to go. It's the most practical, most sensible thing which is happening. So I think it's here to stay. And technology is only being aided to simplify the kind of situation which I just described to you. So technology is very important for execution, but technology is not the answer for all the challenges of the industry.
No, absolutely. And I think there is a particular category to suit all palette, and I would say to suit every wallet. So if your wallet share allows you to go distribution and you are very comfortable, see, it's also about trust, right? You need to trust somebody with your hard-earned money, and it may or may not happen with fintechs all the time. It probably could be, I'm a very big lover of IKEA products, for example. But for God's sake, I can't do the assembly. So DIY is not for me as far as furniture is concerned. But if DIY is something which is okay from a financial services perspective, then go for it. So एक म्यान में दो तलवार रह सकती है, right? And on the technology point, Akhil, staying on that topic, this we discussed it from a distribution perspective. How is technology shaping the manufacturer, the mutual funds? In your case, how are you guys doing things differently? Are you seeing some trends which are going to shape the industry and which is powered by technology?
Yeah, so I think quant is something which is emerging now, which is all about using technology or machine learning or looking at the past data and then trying to arrive at some kind of a strategy, which can give you some sense as to what can happen in the future. So quant-based investing is where I feel that a lot of work is going on. A lot of people, a lot of managers are working around that. We've also attempted. We've launched one quant-based products around factor strategies with protection of portfolios. So I think that space is where I'm also seeing a lot of curiosity from my meetings with distributors and investors. So that's one space which is emerging where technology could play an important role. Apart from that, technology also plays an important role in terms of in distribution also, right? If you have to, largely most products are sold on past data, past performance, right? So if distributors can come out with models, research models, putting in all the data all together and then come out with some predictable models and create basket of portfolios and making life easy for the end investor that you pick one basket, two basket, three basket depending on your risk. It makes life a little bit more easy, right? So I think there is work going on and this is a space which is also emerging.
So, where humans are not able to probably see something beyond the obvious, I think that is where tech is getting to be a very, very critical, I would say, enabler or a Sudama to the Krishna, if I were to say. So I think that's where it has to work as business and technology invariably will have to work as two in a box.
It will also be a mix of, there will be a human interface in between, right? So you can create models. Now, as long as the models do well, it's fine because eventually it is about outcomes. But if the outcomes are wacky, and if there are, underperformances, then the manager or the expert has to go inside the model, reassess the data and then plug it, right? So it's going to be a combination depending on what the outcomes are really coming out in a live scenario.
No, true that. Aashish, technology we discussed and, it's to remove biases, right? We have to cover the third important element. We did the manufacturer, distributor, third is the investor. In your interaction, when you really meet investors across the length and breadth of the country and the world, what are the typical biases that you encounter? And I know greed and fear is obviously at the bedrock of all of that. And how do you really counter some of these biases? Is it easy now that you're saying that, oh, the industry is popularized, mutual fund sahi hai, investment mein paise nuksan nahi hote, longevity, all that is fine. But do you still encounter some naysayers? How do you, identify some of these most common biases?
See, I'll tell you a couple of biases which are, I don't know if they're documented or not, but since you gave me the opportunity to share from my experiences, and somewhere in the beginning you alluded a bit to factor investing, which we didn't really speak about. I'll just correlate the two things. See, one bias which I come across very often is this thing that, intelligent explanations have predictive power. That's a bias. So, for example, if what I've seen with investors is that, let's say your portfolio is cast in a certain way, and then something happens in the market which was not expected, your portfolio is not prepared for it, and let's say you see a downside, or let's say you see that something which you're owning is not performing, but something else is actually blowing the lights out. Okay, so something happens in your portfolio which is outside your expectation. So, you start looking for explanations. So, you switch on to the TV. Like say in October 2021, everybody said Amrit Kal, but by May 2022, everybody was saying Third World War. Nifty is down 25-30% from the peak. So people start looking at, advisors, television, newspapers. What happened? हमारा तो अमृत काल आने वाला था. So they say, हाँ अमृत काल आने वाला था, लेकिन अभी तो यूक्रेन रशिया का वॉर होने वाला है. Right? So what happens is that generally I have seen that whenever something goes wrong with the portfolio, people start looking for explanations. ऐसा क्यों हुआ? Right? It's like your favorite employee leaves, you want explanation. You have a fight with your best friend, you want explanation. So same way, why is my portfolio, why is somebody else's portfolio doing well, why am I doing badly, you get explanation. So when people get us intelligent, and there's no dearth of intelligent explanations after something happens, insightful explanations that this is what happened, right? So once people have digested and that explanation gives them a scientific closure that, okay, this is why it happened. So then people start thinking that, okay, now this has left me wiser. And now I'm going to apply this knowledge in future. But next time, something else is going to rock the boat. So same way with factors. Now see what has happened in last 5 years, there's violent rotation of performances. So 3-4 years back, 5 years back, it was growth. During COVID, it was quality, defensive stuff. Recently, it has been value, cyclical, high beta. So now factor investing has become very famous, very popular, being widely discussed. Why? Because people have realized that, oh my God, it's not the fund managers or their portfolios. It's the factors which are suddenly creating tailwinds for something and creating headwinds for something. So a vast majority of people have now understood that factors can. So now they started thinking that, okay, now I'm going to select funds which have certain factors in it. Now look, just because you got an explanation of which factors worked when doesn't mean you can predict which factor will work in future. In fact, picking the right factor is as difficult as identifying the next sector or performer or winner or fund manager. So I think this is a bias which is something people need to be mindful about. That just because you got a perfect understanding of the past doesn't mean you become any wiser at predicting the future. Sure. In fact, the learning should have been that it is impossible to predict the right factor, so we should run a broad portfolio. Instead of that, the learning is turning out to be, now I'll be able to pick the next factor. I think that's a problem.
No, and also important is that, you should not get carried away. I think getting swayed, whether it's emotional swaying or market, tip swaying, all of that, I think these are inherent biases which are impediment to our own wealth creation.
Yeah, so I've coined a new bias of my own. Intelligent explanations have predictive power. That's a bias.
Yeah, that's a good one actually, and Akhil, there are a lot of aspiring investors also who are watching this podcast. Anything that you'd like to share with them, say from your own personal investment journey that can, probably motivate them to go kick ass, for example?
Yeah, I think I would always suggest that keep your portfolios use the KISS principle, so keep it simple and stupid, right? So do long-term investing, invest every time you have money, invest money, pull out only when you need the money, right? Irrespective where you are, where the markets are. If you need money, you need money, right? So I think, given my experience, the first 10 years of experience has been extremely bad because information was not there. You wanted to become rich too fast, right? So the first fund I bought was a was a IT sector fund, NF4, 10 rupee, and then there was a dot-com crash and 10 became 2, right? Actually book loss, and I, 10,000 rupee, I took out 2,000 rupees, might as well I spend it, right? And then, regulations were not strong, so obviously I did my future option, this, that, again burned the money. But serious investing really started from 2008 after Lehman crisis. Just started putting 30-40% of my net take-home salary into SIPs, and now it's been what, 10, 15 years, good compounding, been through all cycles. So do regular investing, whether it's SIPs or manually, and just be long-term and just don't bother about market cyclicals. In fact, if you can, I mean, if you're talking about biases, and things are changing, I think you should keep buying more and more on the dips, and that will help you in your compounding journey, right?
Lage raho.
Lage raho. See, the thing is that last 3-4 years, we've seen an influx of investors, right? Number of unique investors have doubled from 2.5 crores to 5 crores. So I would say that these 2.5 crore new, especially the retail investors, the first-time investors, young kids, I think a lot of kids from in colleges are also putting money into markets. Now, they've not seen a real bad cycle where you really lose 40-50%. So, once that kind of a cycle will happen, then we have to see how the response will be. But to those people who have actually come in the last 4 years, my advice would be that be prepared for a bad time. One of these years will be a big fall, and if you stay on, the compounding will continue. If you move out, the compounding journey will be broken. So just stay on, is that what I will say.
Yeah, and these are very commonsensical, right? I always wonder why is it so uncommon. But yeah, I think that's where professionals like us still earn our monthly wages, if I were to say.
He came with one bias, so you used a technical term. The other bias which I can talk about is, neighbors envy, owners pride, right? दूसरे के portfolio में कितना return चल रहा है, हमारे में कितना चल रहा है, and then you are always churning to get into something which is working and something which is not working. In fact, most money is made by betting on managers who are good and who are going through a bad cycle, and then you see that hockey stick return. Rather than getting into a manager who's really on top, and then it's like a reverse journey and you have to hang on.
No, undeniably. So I think we've covered, a very, very enriching, I would say, topic, which is, relevant in today's terms. Might sound cliche at times, but I think we did do justice to the time that we had. I would like to, probably ask, alternate questions to the two of you, and the answer has to be a Bollywood movie, if you can. Okay.
He'll be good at that. I'm not good.
Hollywood भी चलेगा, मुझे अंग्रेजी समझ नहीं आती है, but or one-liners. You can give any taglines, so you can let your creativity ooze out to the extent possible. Aashish, I'll go with you first. A movie which best describes the mutual fund industry.
जाने भी दो यारो.
Very good. Akhil, a movie or tagline which best describes market movement.
कभी अलविदा मत कहना.
Excellent. Aashish, one advice you would give to a fund manager who is sitting on cash.
How do you beat Vishwanathan Anand? I'm asking you a question. Play anything other than playing chess, right? So I think holding cash is not the right way to beat the stock market. You're supposed to beat the stock market by being in the stock market. So if you beat Mr. Vishwanathan Anand, it will be called an accomplishment if you challenge him to chess, not to some other sport, right?
Okay, Akhil, any movie or any tagline that comes to the mind when you have to talk to the regulator? SEBI in this case.
हम साथ साथ हैं.
Okay, very good. Aashish, your favorite pastime if you're not selling mutual funds?
Traveling.
Okay. What's your last destination you traveled?
Last destination I traveled to was Scotland.
Excellent. Akhil, any book that you would like to recommend to the viewers, saying that this is the best book I have ever read?
So 2 books. One, of course, he will resonate. I think I'm not too much into books, but the first book we were pushed to read by Motilal ji was Ultimate Sales Machine. I think for all business people, especially on the sales side or business side, I think classic book. I still remember a lot of concepts from there. On investing, I follow a lot of successful veterans and I read all their autobiographies and all that stuff. But if I have to quote one book, then Psychology of Money, I think it makes a lot of sense to read.
Absolutely. I have not read the first book, but I've read The Psychology of Money. It is absolutely fantastic. On that note, thank you, gentlemen. It was absolutely great to do this podcast series with you, and I hope all the viewers also had a brilliant time. On a closing note, I think to sign off in Bollywood language, I would say that with respect to your investments, be like Munna Bhai, give a Jadoo ki chappi to your investment portfolio rather than being Bajirao Singham and constantly saying Ata Maji Satakli. Thank you so much.
Thank you.